Hi everyone. Today we'll be discussing about the energy industry with a specific focus on the cost of capital structure. The cost of capital is estimated using the CAPM represented by the security market line, which shows the relationship between risk and expected return. In equilibrium, all assets lie on the SML. To calculate beta, we use two methods: a linear regression of a company's return against a market index and an Excel matrix calculation of excess returns. The 30-year US Treasury yield was used as the risk-free rate due to its near risk-free nature. We analyzed key market indices including each company's country index, the S&P 500 as a global benchmark, and the MSCI World Energy Index, which tracks top energy firms' exposure to industry cycles. We examined historical data over 5 and 20-year periods as it provided insight into short and long-term expected returns.
On this slide, we'll be analysing Shell. As projected by the table, the FTSE 100 5-year and 20-year betas suggest the stock price will move by 1.06% and 1.03% respectively for every 1% move of the market. The FTSE 100 showcases the largest 5-year and 20-year betas, implying that Shell stocks are most sensitive to the UK markets and even be more volatile than the market itself. The betas for the S&P 500 and the MSCI World Energy Index have shown a declining trend, with 5-year betas being lower than the 20-year betas. Despite reduced exposure to these markets, Shell still likely benefited from the recent booms, driving huge increases in their annual returns. In Q3 2024, Shell demonstrated this by reporting adjusted earnings of $6 billion. Following this strong performance, the company announced an additional $3.5 billion share buyback program, while maintaining its quarterly dividends at 34 cents per share. This reflects Shell's commitment to returning value to shareholders and managing its cost of capital effectively.
BP's highest beta is with the FTSE 100, which was 1.05 for 5 years and 1.13 for 20 years, making it volatile relative to the UK market. Its strong correlation with this index is a drawback, as FTSE 100 underperformance directly affects BP's returns. Despite this high beta, BP's cost of capital remains relatively low because the FTSE 100 index annual returns have been weak, and they were 0.09% over 5 years and minus 1.34% over 20 years, meaning high systematic risk has little impact, and BP must at least match risk-free asset returns to remain competitive. BP's highest returns come from using the S&P 500 as an index due to stronger market risk premium, which was 10.9% over 5 years and 9.5% over 20 years. Meanwhile, BP's lower beta with the MSCI World Energy Index, which was 0.76 for 5 years and 0.91 for 20 years, reflects lower systematic risk, aided by its diversification into renewables and a planned 25% reduction in oil and gas production.
In this slide, I'll be discussing Saudi Aramco's beta values and their implications for risk and returns. Since Aramco was listed on the stock market in December 2019, we unfortunately couldn't collect data for the 20-year beta and return. Its 5-year betas indicate low volatility, with 0.36 for the Tadawul All-Share Index showing slightly higher sensitivity to local markets. Its S&P 500 beta of 0.31 suggests limited correlation with the US market, while the MSCI World Energy beta of 0.26 highlights lower volatility than the broader energy sector. Despite low betas, Aramco's returns remain stable at 8.2% for the S&P 500, 6.45% for MSCI World Energy, and 7.09% for Tadawul All-Share. Saudi Aramco benefits from government backing and market dominance, and this helps explain the reduced systematic risk. This makes Aramco less volatile than most energy stocks while maintaining steady returns.
Let's move to the EU with Total Energies. It is clear Total Energies faces very high systematic risk from the economic conditions of the EU, as shown for its high beta to the Stoxx Europe 600. With Trump tariffs on the EU coming into effect soon, Total Energies is facing a significant hit on the returns. When examining Total Energies' exposure to the US stock market, in the near term it is much less exposed. However, long-term historical trends show movements in the S&P 500 tends to have a significant impact on the returns. Furthermore, the high market risk premium from the S&P 500 means the company faces a high cost of capital as it must strive to deliver comparable returns to investors. Total Energies' high beta relative to the MSCI World Energy Index has shown its returns as highly exposed to the cyclical nature of the energy industry. For example, they have benefited massively from the recent highs in oil prices. This is reflected in the high expected returns from the short term of 9.55%. But looking at long-term trends, expected returns is only 6.01%, almost a 3.5% retreat.
Here we will be analysing Chevron. Chevron faces significant systematic risk from the US market reflected in its higher beta relative to the S&P 500, with a 5-year beta of 1.11 and a 20-year beta of 0.96. As a major US listed energy company, Chevron's stock price often moves in line with the US market trends, leading to its higher beta. This risk exposure directly impacts Chevron's cost of capital. The required annual returns of 16.98% for the 5-year beta and 10.46% for the 20-year beta reflect the higher market risk premium tied to its US market performance. The differences in annual returns highlight Chevron's varying exposure across indices and time horizons. Higher short-term returns reflect recent market volatility and post-COVID economic recovery, while long-term returns suggest more stability and alignment with broader market cycles. Compared to the MSCI World Energy Index, Chevron's lower beta 0.99 over 5 years and 0.89 over 20 shows its alignment with global energy sector trends. This results in lower annual returns of 11.14% and 6.12%, reflecting slower, more consistent global sector growth.
Let's dive into the final energy company of ExxonMobil. The most striking data is how well ExxonMobil has benefited from the recent surge in the energy sector. Using the 5-year beta value of 1.01, the company showed an expected annual returns of 11.28%, almost nearly double its 20-year return of 6.03%. The comparison between the 5-year and 20-year beta values for the S&P 500 suggests that the company's returns have become aligned with the index more recently. Using the S&P 500 as the market index, the annual expected returns should be at 14.53%, much higher than the historical trends. Regardless of whether the MSCI World Energy Index or the S&P 500 is used as the benchmark, ExxonMobil's cost of capital has risen significantly. However, this increase is justified by the dramatic rise in market risk premiums. In the long term, as markets begin to slow down, we anticipate a decline of approximately 5% in the cost of capital.
In this slide, I'll be analysing GSK. GSK's 5-year and 20-year betas are moderate within the FTSE 100, indicating that while its returns are influenced by UK market movements, they do not fluctuate as much as higher beta stocks in the index. Its beta values for the S&P 500 and FTSE 100 are quite similar, at 0.64 and 0.74 over 5 years, and 0.62 and 0.65 over 20 years. This reflects GSK's large US consumer base, making US economic conditions just as important as those in the UK. Using the S&P 500 as a market index results in a higher market risk premium, leading to the highest returns over both time horizons. Over 5 years, GSK's returns were 11.79% for the S&P 500 and 4.89% for the FTSE 100. Over 20 years, they were 8.47% and 4.06% respectively. Its stronger correlation with the FTSE 100 suggests UK factors like economic growth, market structure, and monetary policy play a bigger role in its performance.
Beta significantly impacts CEO compensation, particularly stock-based pay such as stock options, restricted stock units, and long-term incentives. These forms of pay are directly tied to stock price movements, meaning higher beta leads to greater earnings volatility. The higher the beta, the more CEO compensation depends on external market conditions rather than company-specific performance. GSK CEO earned £10.6 million with a significant portion in stock-based incentives. Since GSK has a lower beta, CEO pay is stable but lacks high earnings potential from stock appreciation. In contrast, BP CEO pay is undisclosed, but with a moderate beta. Stock-based incentives are highly uncertain as BP's stagnant stock performance in the last 5 years limits gains. Chevron CEO earned $23.6 million and ExxonMobil CEO earned $35.9 million, with over 30% of their pay coming from stock awards. Their high beta results in volatile but highly rewarding compensation when stock prices rise. Shell and TotalEnergies also see fluctuations in stock-based pay, while Saudi Aramco's low beta ensures the most stable CEO compensation with minimal market exposure.
Now for the comparative analysis. When looking at 5-year and 20-year betas in all the energy companies, their returns are most sensitive to their home country indexes, except for ExxonMobil. On the other hand, GSK is less affected by the country's business cycles, as evidenced by a significantly lower beta with the FTSE 100 compared to Shell and BP. It seems the 20-year betas for the MSCI World Energy Index is very similar among the energy companies. However, examining the 5-year betas, the US-based companies such as Chevron and ExxonMobil have presented much higher sensitivities to the energy sector. And given the recent supply-side shocks in oil prices, US energy companies were better positioned to capitalize on the sector's substantial upturn and sustain similar returns. Furthermore, Chevron and ExxonMobil are expected to see an additional boost in annual returns by operating in the US and benefiting from the country's strong recent economic performance. Similarly, GSK is well positioned to leverage its robust US customer base, leading to higher expected earnings compared to its European counterparts such as Shell, BP, and TotalEnergies. In the long run, the geographical advantage of US energy companies diminishes. This is shown by historical trends indicating most energy companies will have similar returns of 9% annually. Additionally, the cyclical nature of the energy sector stabilizes over time, diminishing Chevron and ExxonMobil's recent outperformance and causing returns across all energy companies to converge to approximately 6%. Whether those returns are 9% or 6% it's clear returns will be similar across the industry either way.